I want you to close your eyes for a second. Well, assume you're not driving, obviously. But just imagine opening up your phone.
Right, the dreaded portfolio check.
Exactly. You tap on your brokerage app or your retirement account, and right there on the screen, just staring back at you in glaring red numbers, is a 90% loss.
Oof. Yeah, that is a gut punch.
It really is. I mean, 90% of your money just gone, evaporated.
Yeah.
So do you panic? Do you sell whatever you have left? Or do you just sit there and do absolutely nothing?
Which is, surprisingly, the hardest option.
Totally. And today's deep dive is really about why doing nothing is historically the most profitable, but also the most psychologically agonizing choice you can make.
Definitely.
We're pulling our insights today from Gregory Scola's work, specifically his audiobook, Surviving Market Bubbles, The Leaking Pound, How to Build Your Wealth, and the Mystery of Money That Quietly Disappears.
A long title, but yeah, incredibly relevant stuff.
Super relevant. The mission of this deep dive is to uncover this really surprising truth about building wealth. It's actually less about having some genius-level intellect or perfect timing.
Right, and almost entirely about human behavior.
Yes. It requires the emotional endurance to just be incredibly painfully boring.
Okay, let's unpack this because we really want to customize this to help you cut through the noise of financial panic.
And that noise is loud. We're conditioned to believe wealth comes from, constant action.
Right, like being a day trader.
Exactly, outsmarting the system. But Scola argues that activity is usually the enemy of compounding.
So to test that, we really need to look at the absolute worst case scenario, like a massive bubble inflating and then just violently bursting.
The ultimate stress test.
Yeah. And to understand what separates the survivors from everyone who loses it all, we have to revisit the dot-com crash.
Oh, the late 90s. It's a perfect laboratory for this because the market wasn't just overvalued, it was completely detached from reality.
People were just rushing into tech stocks. Right, and these companies had no profits, no sustainable business models, just...
really cool websites with lots of exclamation marks.
Exactly. Investors poured billions into them based purely on momentum.
That then the bubble burst. And so many of those companies just went poof.
Yeah.
They vanished completely.
Yep, down to zero.
But, some did survive. Like Amazon. Amazon survived, but its stock still dropped by over 90%.
Which is terrifying to live through.
Oh, for sure. Holding a stock through a 90% drop is like being strapped into a roller coaster that visually appears to be flying completely off the tracks. Most investors sold in extreme pain, just questioning all their life choices.
Yeah, they capitulated.
But the ones who stayed were highly rewarded.
Yeah.
So, but wait, in the moment, how do you actually know you're holding the next Amazon and not one of the companies that just goes poof?
Well, what's fascinating here is how Scola shifts the focus. He moves it away from trying to predict the drop and instead focuses on evaluating the underlying asset's actual resilience.
Oh, it's
Yeah, the key question isn't, will it fall? Because in a crash, everything falls. The real question is, will it recover?
right.
And to figure that out, he suggests this exercise called the honest label.
The honest label. Okay, how does that work?
You basically look at your assets and categorize them, which are long-term strong, meaning you hold them through anything because they have real value, and which are speculative.
Like the ones you bought just because someone on the internet was super excited about them.
Exactly. And there's no judgment there. We've all bought things just for fun or hype.
Oh, totally. Guilty as charged.
But the psychology behind this honest categorization is that it prevents panic selling.
Because you already know what it is.
Right. You've acknowledged the risk level beforehand. So if your speculative coin drops 90%, you don't panic because you already labeled it a gamble.
That makes a lot of sense. But if picking individual surviving stocks, like Amazon, is that terrifying and perfectly timing the market is practically impossible.
Which it is.
Then how do we actually make money? Which brings us to this idea of consistency over timing. And I love this part. We have to introduce you to Alex.
Ah, Alex. Poor Alex.
The investor with literally the worst timing in the world. He only ever buys right before massive crashes.
Scola makes this great joke about him. He says if Alex bought a sandwich, the bread would go stale before the transaction even completed.
That is exactly his luck.
Yeah.
So Alex buys right before the dot-com crash. He buys right before the 2008 financial crisis.
Flawlessly terrible timing.
But despite this, Alex becomes incredibly wealthy.
Wait, really? How?
Because he never sells. And he just keeps investing. He
Uh,
never liquidates. Markets recover. His compounding continues. And his extreme patience basically outweighs his terrible timing. Consistency beats perfection.
So he's actually better off than some theoretical genius who buys at the exact bottom, gets nervous, panics, sells early, and then has to buy back in at the top.
Exactly. Scola even has an exercise for this called the Alex mantra. You're supposed to write it down and post it up somewhere. It just says, I do not need to be perfect. I need to be consistent.
I love that. It takes so much pressure off.
Here's where it gets really interesting, though, because to me, Alex is basically a surfer who paddles out right as the wave crashes directly on his head. But instead of quitting, he just stays in the water until the tide inevitably comes in.
That's a great way to put it. And if we connect this to the bigger picture, it explains the mathematical power of compounding.
Right.
Removing that pressure of finding the perfect entry price is actually a psychological superpower for you as an investor. You don't have to be psychic.
You just have to be in the water.
Exactly. You just stay in the water.
But okay, knowing that we just need to be consistent like Alex, what exactly should we be consistently investing in? Because if we just keep buying the bad companies that go poof, we're in trouble.
We just go broke consistently.
Right. So we need a strategy so we don't end up holding garbage. And the answer is surprisingly simple, though it was like heavily criticized when it first came out.
You're talking about 1976.
Yes. Enter John Bogle. He introduces the very first index fund through Vanguard.
A total game changer. The concept was just keep it simple, track the whole market, and keep costs extremely low.
But the initial reaction was brutal, right? People hated it.
Oh, Wall Street despised it. They called it un-American. They were like, this is boring, it's underwhelming, you'll never get rich doing that.
Because it threatened their massive fees.
Exactly. But the reality today is that index investing is a massive, undisputed historical success.
Yeah, Bogle is a hero now, and all those critics are basically forgotten.
I know.
The lesson Scola takes from this is that complexity reduces returns.
Fancy is expensive. Boring compounds.
Boring compounds. I like that. He has this exercise called the 20-year test. Simple addition. You basically design a very simple portfolio, maybe like 80% in a global ETF and 20% in bonds.
Very standard.
And you just ask yourself, could this work for 20 years?
Right.
And if the answer is yes, you just stop reading financial news, like at least on the weekends.
Which is great for your mental health, honestly.
But let me play devil's advocate here for a second, right?
Sure, go for it.
Doesn't tracking the market feel kind of counterintuitive to human nature? I mean, it feels like purposely settling for a C-grade average instead of trying to be the A student who actually beats the market.
That is the exact trap most people fall into. But in investing, trying to be that A student often results in an F.
Wait, an F how?
Because of the friction. You're trading more, you're paying management fees, you're incurring short-term capital gains taxes, and you're making emotional mistakes.
All those hidden costs.
Right. By the time you pay for the privilege of trying to beat the market, your actual net return is worse than the index. So the boring strategy is actually the most intellectually rigorous choice you can make. You're optimizing for guaranteed low friction.
Wow. Okay, so if the strategy is genuinely that simple, like just buy a boring index fund, hold it for 20 years, and ignore the news, why do so many people fail at investing?
That is the million-dollar question.
Right. Because it turns out the final boss of building wealth isn't the market at all. It's our own psychology.
It really is. Success in investing isn't about having better information or fancier tools or like 6 screens with flashing red and green lights.
God, no.
The biggest difference is purely behavior.
Scola quotes Benjamin Graham on this, right? The father of value investing. He said, the investor's chief problem is likely to be himself.
And he was so right. The real threat isn't the stock market. It's not the economy. It's not the government. It's you checking your portfolio prices at 2 in the morning.
Letting your anxiety just take the wheel.
Exactly. Because the markets will always rise. They will fall. They will surprise you. You absolutely cannot control the market.
But you can control your discipline. You can control whether you open social media during a massive crash.
And Scola practically begs the reader, please don't do that.
Seriously, do not. Wealth is built by basically sitting on your hands and being boring. So he gives us one final exercise, which is to write your investor identity statement.
I really like this concept.
Yeah, you write it down and you read it during weird, volatile markets. It goes, I am an investor who invests regularly, does not panic, thinks long-term, follows a plan, and does not take advice from strangers on social media.
Especially if they use rocket emojis.
Especially the rocket emojis. That is a huge red flag.
It really is. So what does this all mean?
Well, I kind of think about it like this. Having all the best financial apps and tools, but having terrible emotional control It's basically like giving a Ferrari to someone who only knows how to drive in reverse.
That is a brilliant analogy, and this raises an important question for you listening right now. You have to reflect on your own habits.
Yeah. Are you the person driving in reverse?
Are you the one checking prices at 2 a.m.? Because true wealth, at the end of the day, is just the byproduct of mastering your own impulses.
Absolutely. Okay, let's wrap this up. We've covered a lot of ground today. First, we talked about enduring the massive drops, figuring out what has actual value with the honest label.
Then we embrace the terrible timing of Alex, proving that consistency matters way more than perfection.
Right. And we celebrated the incredibly boring genius of John Bogle and his index funds. And finally, we realized that avoiding rocket emojis on social media is like a legitimate financial strategy.
It really is. But, I want to leave you with a final thought to mull over, something that builds on everything Scola talks
Oh,
about.
let's hear it.
So Scola makes this super compelling case that you can't control the market, only your behavior, right? And that sitting on your hands in a simple index fund is the ultimate strategy.
Right, the Bogle approach.
But think about this. If boring index investing becomes what absolutely everyone in the world does, and everyone is just sitting on their hands refusing to trade, how will the market actually figure out what a company is fundamentally worth? Does the ultimate success of this whole boring strategy fundamentally rely on the fact that there will always be some people willing to panic, gamble, and act irrationally?
Oh, wow. So the calm indexers actually need the frantic day traders to set the prices. That is wild to think about.
It's a paradox, isn't it?
It really is. Well, thank you so much for joining us on this deep dive. Make sure you take that investor identity statement out into the real world. Keep it handy. We'll catch you next time.